Hey everyone, welcome back to Corporate Decoder. Today, BPAC just filed its quarterly report, and I'm seeing a massive $1.2 billion deal in the works. Quick note, this is not financial advice, just my take on public filings for educational purposes. It looks like Blueport Acquisition is gearing up for a huge merger, but the financials reveal some telling details about their current state. Blueport Acquisition, known by its ticker BPAC, has just released its quarterly financial update. This is a standard report for public companies, giving us a peek under the hood at how they are doing for the 3 months ending the 31st of March 2026. Now, Blueport is what is called a blank check company, also known as a special purpose acquisition company, or SPAC. Essentially, these companies are formed to raise money through an initial public offering to acquire an existing company. They have a limited time to find a target business and complete a merger. As of May 13th, 2026, the company had over 5.9 million Class A shares and about 1.4 million Class B shares outstanding. The Class B shares, often called founder shares, usually belong to the company's early investors or management and typically have different voting rights. Let's dive into the numbers. Looking at their balance sheet, as of the 31st of March 2026, Blueport Acquisition had about $97,000 in cash. That might sound small, but SPACs operate differently. The bulk of their assets, over $58 million, is held in a trust account. This is the money raised from their IPO that is set aside to fund a future acquisition. Their total current assets stood at around $210,000. This includes the cash and some prepaid expenses. On the liabilities side, they had about $161,000 in accounts payable and accrued expenses. A significant item here is the deferred underwriting fee of $1.15 million. This is a fee that the underwriters earned but will only be paid upon the successful completion of a business combination. It is a common feature in SPAC deals, aligning the underwriters' incentives with the company's success. Then we have the Class A ordinary shares. A big chunk of these, over 5.7 million shares, are classified as subject to possible redemption. This is a crucial detail for SPACs. It means that shareholders who bought shares in the IPO generally have the right to get their money back if a business combination isn't completed within a certain time frame, or if they simply choose not to participate in the deal. As of the 31st of March, these redeemable shares were valued at over $54 million. All of this adds up to a total shareholders' equity of about $2.4 million. It is important to remember that for a SPAC, equity doesn't always reflect the operating value of a business in the traditional sense, especially before a merger. Now let's look at how they performed in terms of income and expenses for the 3 months ending the 31st of March 2026. Blueport reported a net income of about $150,000. This might seem positive at first glance. However, it is important to understand where this income came from. Their general and administrative expenses, the everyday costs of running the company, were around $359,000. So, on the surface, they spent more on operations than they technically earned from them. The net income of $150,000 was actually driven by about $509,000 in interest earned on the money held in their trust account. This is typical for a SPAC. They aren't generating revenue from active business operations. They are earning interest on the IPO proceeds parked in safe investments. When we look at the earnings per S-share for shares not subject to redemption, it shows a net loss of about $0.17 per S-share for the quarter. This highlights that even with the interest income, the core operation of the SPAC itself resulted in a loss for the non-redeemable shareholders. Looking at the statement of changes in shareholders' equity, we see how the equity accounts have shifted. For the 3 months ending the 31st of March 2026, there was a net income of $150,174. But crucially, there were also significant adjustments related to the redeemable shares. We see a line item for accretion of carrying value to redemption value, which was nearly $922,000. This represents the increase in the value of the redeemable shares towards their ultimate redemption price. This accounting adjustment significantly reduced the overall shareholders' equity. Going back to the very beginning, from the company's inception on the 13th of January 2025 through the 31st of March 2025, they reported a net loss of about $9,000. This was primarily due to initial formation and operating expenses. In terms of cash flow for the 3 months ending the 31st of March 2026, Blueport used about $383,000 in operating activities. This is largely due to the expenses we saw earlier not being offset by any actual revenue. There were no cash flows from financing activities in this quarter. This is because the IPO and private placements were already completed in the previous year. For the initial period from January 2025 to March 2025, they received about $9,000 in financing, likely from related parties to cover initial setup costs. Their cash balance at the end of the period was about $97,816, down from over $480,000 at the start of the quarter, reflecting the cash used in operations. Alright, let's talk about what this all means. Blueport Acquisition Ltd is a blank check company, formed to find and merge with another business. They had their IPO in November 2025, raising over $57 million. They are a relatively new company, only starting operations in January 2025. Their main goal is to complete a business combination within 15 months from their IPO, meaning they have until around February 2027 to find a target and close a deal. If they don't, they have to liquidate and return the money in the trust account to shareholders. And this is where it gets interesting. On May 1st, 2026, Blueport entered into a merger agreement with a company called SINGAUTO Inc. This is the big deal that could make Blueport a significant player in its target market. The deal is structured as a two-step merger, ultimately creating a new publicly traded holding company. The proposed merger values SINGAUTO at a massive $1.2 billion. This will be paid entirely in stock, with SINGAUTO shareholders receiving 120 million shares of the new company called PubCo at a value of $10 per share. This suggests that the market, or at least the parties involved in the deal, see significant value in SINGAUTO. Now, let's talk about a really important note here. Going concern consideration. The company acknowledges that as of the 31st of March 2026, they had very little cash on hand outside of their trust account, which has significant restrictions. They have a deadline to close a business combination. If they don't, the company will likely wind up and dissolve. This means there is substantial doubt about their ability to continue as a going concern for the next year. This is a common situation for SPACs that haven't yet found a target or are in the process of a merger. The success of Blueport Acquisition now hinges almost entirely on the successful completion of the SINGAUTO merger. Many external factors, like market volatility and geopolitical events, could also impact their ability to finalize this deal. The company's investments held in the trust account are valued at over $58 million. These are currently marked at fair value, with the valuation falling into level 1, meaning they are based on quoted prices in active markets, which in this case are likely US government treasury bills or money market funds. The accounting for these redeemable shares is quite complex. They are treated as temporary equity, and their carrying value is adjusted over time to reflect the redemption value. As of the 31st of March 2026, the value attributed to these redeemable shares was over $54 million. This is a huge portion of their equity, showing how much of the IPO money is potentially going back to the public shareholders. When we look at the earnings per share, it is bifurcated. The redeemable class of shares actually show positive earnings of $0.08 per share for the quarter. This is an accounting outcome of how the interest income and warrant impact are allocated. However, the non-redeemable Class A and Class B ordinary shares show a net loss of $0.17 per share. This is a clearer indicator of the operational performance for the company's core stakeholders. To recap the IPO, Blueport sold 5.75 million units at $10 each, bringing in $57.5 million. Each unit had a class of share and a right to receive a fraction of a share later. The company has several related party transactions. The sponsor, Blueport Acquisition Corporation, provided founder shares and loans. Importantly, the sponsor provided founder shares. Initially, they issued close to 2 million shares, but then forfeited over 500,000, resulting in about 1.4 million founder shares outstanding. This is typical for SPAC sponsors, who often get a large chunk of shares at a very low price. There is also an administrative services agreement where Blueport pays its sponsor $10,000 a month for office space and support. For the first quarter of 2026, this cost about $30,000. Under the underwriting agreement, Blueport paid cash underwriting discounts and is committed to a deferred underwriting discount of $1.15 million, payable only upon the completion of a business combination. This deferred amount is essentially an incentive for the underwriters to help secure a successful merger. In their management discussion, they reiterate the risks and uncertainties, especially concerning market volatility and geopolitical issues that could affect the business combination. They clearly state they have no operating revenues and expect significant costs related to being a public company and finding a target. Their liquidity section emphasizes that the $57.5 million from the IPO and private placements were largely placed in the trust account. The funds outside of the trust account are limited, and they are exploring options, including potential loans from the sponsor to cover operational expenses until the business combination. Importantly, they state they have no off-balance sheet financing arrangements. This means all their financial obligations and assets are reported on their balance sheet, which is good for transparency. The filing details key agreements related to the proposed merger with SINGAUTO, including shareholder support agreements and lock-up agreements. These are crucial for ensuring the deal moves forward smoothly and that major shareholders are aligned. As a smaller reporting company, Blueport is not required to provide detailed market risk disclosures. They confirm their disclosure controls and procedures are effective, meaning information is being properly recorded and reported within required timelines. Finally, the exhibits list the merger agreement and other related documents showing the formalization of the SINGAUTO deal. So, what is my take on all this? Blueport Acquisition is in a classic SPAC situation. The core business, aside from earning interest on parked cash, is essentially dormant until a merger. The significant net income is misleading as it is all from interest income, not actual operations. The real story here is the proposed $1.2 billion merger with SINGAUTO. That deal represents their entire future. If it goes through, Blueport, or rather the combined entity, could become a substantial player in its sector. However, the going concern warning is significant. It highlights the high risk inherently tied to the success of the SPAC merger within the stipulated timeframe. The significant portion of shares subject to redemption also means that if shareholders get cold feet or the deal is unappealing closer to the vote, a large chunk of the IPO money could be returned, impacting the capital available for the combined business. My biggest concern is the reliance on a single, large transaction for the company's entire existence and future. I'm watching to see if this SINGAUTO merger creates a sustainable, growing business or if it follows the path of many SPACs that have struggled post-merger. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded, like, comment, subscribe, and join our Discord for more.